Okay everyone, welcome back to the Price Action Labs YouTube channel. In this video, I'm going to be going over an $875 12-minute trade using order flow, but more specifically flow state. So I'm going to be breaking down how flow state found my key levels, how I was able to use order flow to execute at those levels on a short ES trade I took on the 30th of June 2026. So with that being said, let's dive into it. So in this video, I'm going to be going over an extensive case study on everything that I use to take the trade all the way from how I planned my session down to the short execution. So let's kick things off right away. So in this video, I'm going to be going over 4 main ingredients, right? All from the Flow State OS app, which is I use the 4-step positioning process to help me find my levels using structure, targeted liquidity, equilibrium, and price imbalances. This is step 1, how I identified my key levels. Step 2 is my R.E.A.D formula. So once price enters my key level or my price imbalance area, whatever you want to call it, how am I using and reading price action to give me the best overall analysis in real time? This is basically where key levels meets order flow. The next thing is the T.R.A.P method. So it's using the order flow systems and methodologies to help me understand whether to buy and whether to sell. And in this part of the video, I'm going to explain how the order flow told me to sell at that ES key level. And last but not least, it's the entry model. So how do I take all of the components that I'm using and put them into a 4-pillar or 4-step executing system with order flow on the 1-minute time frame? So these are the 4 components of this video. These are the 4 learning objectives. So step 1 is about positioning. So this is the first P in the premium footprint execution process. So as you can see on the chart, the yellow box represents the previous day high from the 8th of June. So I'm going to be explaining why this was a key level and how it gave a good short for me, and also how it gave a good long, right, afterwards, which I didn't actually take, right? The main trade post 11 a.m. Eastern was a long. I'm going to break down the short trade that I took over here, short scalp counter trend. So the first part of this video is about identifying key levels, and I'm going to explain exactly how I found them, right? So step 1 to identifying key levels is about market structure, right? So it's understanding the highs and the lows on the 15-minute time frame on ES futures, okay? Now, step 2 is about targeted liquidity, right? So which areas, which key highs and lows am I most interested in? Next is about equilibrium. So this was a trade that actually happened in premium, and that's the main reason I was shorting from a positioning standpoint, right? And the final thing is price imbalance. And what you'll notice is that with the positioning process, these 4 steps read the word step, and this is why I call it the 4-step positioning process. It's the same 4 mechanical steps in a repeatable system that I follow each day to identify my key levels. And so step 1 is about market structure. So this is the 15-minute time frame on ES futures or the S&P 500, essentially same thing. So if we just take a look here at structure, this is how I mark out my structure. So I get lots of questions about market structure, and I'm going to take this video to extensively break down each and every step. Starting with step 1, which is basically structure. So the way structure forms is that there are essentially highs and lows in the market, and my job is to map them out. So I look for lows, highs, lows, highs. What you'll find is that these are typically session highs or previous day highs and previous day lows. So the most important thing to understand here is there's a couple of things. There's 2 main rules I use when it comes to identifying a market structure. Now, the first rule sounds pretty obvious, but a lot of people get this mistaken or they get it wrong. Every high has to produce a low, right? And every low has to produce a high. So what I mean by that specifically is that when you have a high over here, right, this is only a high because it produces a new low. This is a high because it produces a new low, and this is a low because it produces a new high. So the point I'm trying to make is that all the highs and lows you see in between are all internal. I have not marked them out because they are not part of overall market structure. This is very important when it comes to identifying key levels, premium and discount, and the right areas to trade from. So that's rule number 1. Rule number 2 is something which comes with a bit of practice, is I'm looking for sharp moves up and sharp moves down. These represent the pivot points or the areas that I'm most interested in. So as you can see here, even if we start from here where I haven't marked it up, what you'll see here is you have a sharp move down, sharp move up, sharp move down, sharp move up, sharp move down, sharp move up, right? All these sharp moves. Now, yes, technically you could actually mark this out, but for me, this is more of a range. And then we have the gap here going into the new week. So for me, this is roughly how I mark out my structure, right? So you want to follow the two rules you see on your screen. Each high has to make a low, each low has to make a high, using both the sharp move up and down theory, right? So once you get good at marking out structure in this way, we then move on to step 2, because step 2 is about targeted liquidity. So what you'll notice is that we've actually taken step 1, or the structure step, and now we've combined it with step 2, the T step, which is targeted liquidity. And what targeted liquidity stands for essentially is basically taking the most recent low and the most recent high. And everything in between is known as a dealing range or structural dealing range. So we're only really interested in this most recent low and this most recent high. This is what we refer to as our dealing range. Now, the dealing range is very important, because once you have the dealing range, again, it's the most recent high and the most recent low from structure. The reason this is important is because now we move on to the E step. So STE, E is about equilibrium. So once you've got your market structure like this, you want to divide the most recent low and high into basically two sections, right? Two equally or equidistant sections, right? This is the equilibrium, and it's the halfway point between the most recent low and high. Now, what this refers to, or what this gives us, is a couple of things, right? It gives us our premium, so above the 50%. That's where today's trade came from. The best short trades will come from premium, and the best, as you can see, long trades will come from discount. This is the basic concept of selling high and buying low. This is how we use that same concept on candles on the charts, all right? So premium is about selling above the 50%. Discount is about buying below the 50%. And so this trade, or the trade I'm about to go through, directly used the concept of selling in a premium above this 50%. And the reason why the equilibrium step is important is because this is where we find our key levels. And so this is what my chart looked like on ES. Okay, so it may look complicated, but all we've done is we're using the price imbalance step in premium and discount. So all the levels you see over here, number one, they're all order flow backed, so they're not formed from candles. I'm just showing you on TradingView how this forms. All of these levels are identified on the footprint charts. I'm just showing it to you on a candlestick chart. Okay, so this was where the key level was derived from. So it's quite interesting. It was the 8th of June. And the trade I took was, of course, on the 30th of June. So that's about 2, maybe 3 weeks later, the same key levels apply. And the reason why is just from a positioning standpoint is this is a solid key level that's now in the premium, right? It's above this 50% area. As you can see, this is the 50%. We were above the 50%, and that is the reason why I took the short from this level. All right, so I've had lots of questions about how I find my price imbalances. So I'm going to break down how I found this price imbalance. So this was the key level, which was formed on the 8th of June, 2026. Now, I took the trade on the 30th of June, and I'm going to explain why that yellow box was such a good key level. So this is what it looks like when it's zoomed up, right? The yellow region will show you. So for those who've had some kind of ICT or smart money concept background, you will understand what this region represents, this little square over here. That is a price imbalance, otherwise known as a fair value gap. You can call it an inefficiency, a void, whatever you want to call it. This is what we refer to as a price imbalance, right? So STE, this is what the P stands for. This is price imbalance. So the 3 rules to finding a key level based on price imbalance is this. You want to identify a previous day high or a previous day low, right? These are some of the best, strongest, and most reliable key levels that you can have conviction in. Once you've done that, you want to identify a fair value gap / price imbalance near a previous day high or a previous day low. So the key level for today's setup was, of course, a previous day high from the 8th of June that left a price imbalance. And what we want to do is we want to draw that gray box from the candle before the start of the fair value gap. So a lot of people get this mistaken, but this is a very clean and critical example of a key level that you can abide by. So what we've done is we've identified an FVG or a price imbalance. We've now taken the candle before the start of that price imbalance, and it corresponds to the previous day high from the 8th of June. Okay, just a quick one on previous day highs and lows. The reason why a previous day high, for example, is such a good key level is because a previous day high represents the highest price of that day. So what that means is that's where buyers were exhausted. So in this region here, this was the high of the day. This is where buyers were exhausted. This is where price left an inefficiency. Great key level. So if we just go back to the slide before, what you'll notice that price gave a reaction here, strong, massive supply. Price then gave a small reaction here. We then had a following reaction last week here as well. We had the same reaction for a short and a long at this level. So the lesson to understand is that if you're struggling with key levels, use the 3 steps over here. Identify previous day high / previous day low. Identify price imbalance near or around it, and apply the one candle before principle to find your key levels. This is how I find my key levels, and this is how I've engineered Flow State to do the same. So I recommend you do the same on that one. And so these are the 2 trades that it led to. So once you choose the right key level, you can almost capitalize on both sides of the market, right? Short, which is what I took, and then the main trade, which is long, post 11 o'clock. I don't normally trade past 11 a.m. Eastern. But this is an example of choosing the right fair value gap, choosing the right price imbalance. You can capitalize on longs and shorts throughout the day. All right, so again, one key level from the 8th of June. This is important to understand. The 8th of June is where the key level came from. Once you've identified a key level, you want to drag it across your screen. You want to drag it from left to right. All right, gave us multiple setups 22 days later. And now the question becomes, how do I know which FV price imbalance or fair value gap to choose? How do I know which one to choose from? And so this is what every single person or everyone watching needs to ask is, how do I know which price imbalance to use, right? This is the question I get the most. Which FVG / price imbalance should I use? Which one should I use? And more importantly, why? Okay, so that's where the next section comes in, because the next section is about identifying which key levels in what I call the premium pre-market playbook. And so the premium pre-market playbook, again, it's been engineered into Flow State. And the way that I've designed the premium pre-market playbook is that it tells you which key level to trade from based on real price action, so order flow, at what time to trade from based on 3 principles, right? Maybe write these down, because these are the only 3 things you want to consider between 9 and 9:30 Eastern. So before your session begins, there are only 3 concepts you need to identifying the correct key level to trade from at any given time, right? The first one is about time. Second one is price. Third one is volume. And so my pre-market plan or my pre-market playbook has only 3 components, right? Even today, what time am I going to trade, or what time window? What price am I going to trade from? So that's my key level. And based on volume. So are we in a high volume area? Are we in a low volume area? Once you have all of these three things essentially together in a system, that's what I call the premium pre-market playbook. Okay. So now, once we've identified our key levels, the next thing to understand is this basic formula over here, the R.E.A.D formula. So you want to identify a key level or a price imbalance, right? You then want to combine that key level or that price imbalance with what I call the R.E.A.D method. So I'm going to be discussing what the R.E.A.D method represents. So once you combine the step process with the R.E.A.D method, you get extreme clarity in your trading. And that's what I'm going to break down. So this is the R.E.A.D method. So in other words, I get lots of questions about how do I read footprint charts? How can I interpret footprint charts, right? It's confusing, it's noisy, I'm not sure where to start. Give me about 5 minutes, just watch this entire video till the end and you'll have a lot of clear and accurate sort of understanding of how to do this. So this is what the footprint charts represented for today, or for the trade 30th of June, ES short, right? Scalp trade, 1R. So when you look at a footprint chart, it shouldn't be overwhelming when you look at it through the lens of the R.E.A.D method, right? So R.E.A.D. So first we start with R, which is about recognizing. We want to recognize that there's only 2 numbers you want to read inside of one box. And that is essentially the whole of order flow trading. It's 2 numbers inside of one box. Now you don't need to read all the numbers, but you do need to understand what the left and right number represents. So the left number in any candle represents the bid. These are aggressive sellers, right? Notice the word aggressive, right? You can look at aggressive as they're hitting the market now. They're hitting the market now at that price at that time. So for example, if we just take a look at, let's just take this candle. We see 53 for 169. What that means is the left number is 153, of course, right? Those represent aggressive sellers. And so in other words, there are 53 people or orders trying to drive price down, right? Aggressively selling. Now, on the flip side, we want to recognize that there's a right number as well, which is the opposite. It's the aggressive buyers. So that's step one. Recognize what the numbers represent. There's only two numbers: aggressive sellers, aggressive buyers. Or another term for that is market sell orders, the total number of market sell orders, and the total number of market buy orders. You got it. Okay. Next is about E, which is evaluate. So once you've got your bid and ask and you understand what they mean, aggressive sellers, aggressive buyers, we now want to evaluate what the footprint charts tell us. And the footprint charts, or the way I use footprint charts, I look at one thing, which is the delta. I look at the delta because I want to know, is it blue or is it red? And what you'll notice that when you look at a footprint chart, you have either blue delta, which I've highlighted here, or in the next slide, you'll have a red delta, which I've highlighted here. Okay, so this is what you want to understand. When it comes to evaluating, that's what the E stands for, evaluate. You want to evaluate the delta. So in other words, delta is defined as the right number minus the left number. Okay, I'm going to say that again. The right number minus the left number. And so in other words, if you just take a look at, let's take again this example here, 69 and 53. So the delta here is going to be 169, minus 53, which is going to be 113. All right. 113. Whereas if you look at this example here, an example down here, for example, it says 225 for 46. So here the delta is going to be 46 minus 225, which is of course a negative delta, hence why it is in red. Whereas up here, 169 minus 53, that is a positive number. That's why it's in blue. So E is all about evaluating what the bid and ask is telling you. Now E links directly onto A, which is about assessing. What are you assessing? You're assessing the aggression. So A stands for either assess the aggression, or A stands for aggression. So in other words, what you want to understand is that the bid and ask will give you the delta. And once you've understood you can have positive or negative delta, that directly links onto aggression. Okay, that's all it means. So if you look at this box over here, what you'll see is that it's mainly this candle. There is a lot of blue delta because you see 422 for 165. This is a positive number, right? 422 minus 165. That number is whatever that is, right? 200 and something. It's a positive number, and therefore the delta is positive. Therefore, buyers are aggressive. That's what it means, right? This is all we're doing. So we're following the R.E.A.D method. We've recognized that the left number and the right number exist. We understand what they are. Now we want to evaluate, right? So we want to evaluate the delta. Is it positive? Is it negative? So now we know positive delta means that buyers are aggressive, whereas negative delta means that sellers are aggressive. Okay, so here's an example of negative delta down here. This is negative delta because sellers become aggressive as I took the short, whereas up here, buyers were aggressive. Buyers were aggressive, right? So hopefully you can see where I'm going with this. Order flow isn't complicated. I want you to think it through with this framework. Recognize, evaluate, assess. Now last, we have detect. Right, so what does detect actually mean? So detect is essentially detect the zero. So what you're looking for is, when I'm looking for a short, I want to see zeros at the top before the short happens. I'll explain later on in the video why I look for zeros. This is otherwise known as a finished auction. So in other words, just think of the market as an auction between buyers and sellers. So for example, if you look here, for example, it says 0 for 66. So what this means is, again, left number, aggressive sellers, right number, aggressive buyers. Aggressive sellers here means that aggressive sellers here means that there's 0 on the bid and 66 on the ask. So the delta here is going to be 66 minus 0. That's going to be, of course, 66. Hence why it's a positive delta. It's in blue. Now we see a zero here, 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 here. We see a lot of zeros at the top. So what this represents is a finished auction. And I'm going to explain later on in the video why that's significant. But this is all you want to look for when it comes to order flow, right? Or specifically footprint charts. You want to recognize, evaluate, assess, and detect, right? That's all you have to do with footprint charts. Now, the next thing, linking directly on from the R.E.A.D method, is the T.R.A.P method, right? So just to quickly sum up what we've been through so far in this video is we have gone through the step process, the R.E.A.D process. Now we're going through the T.R.A.P process. All right. So think about it through this framework. Your key level is like a room, right? So there's lots of key levels. Remember this slide here, right? There's lots of key levels and there's lots of areas which are outside of key levels. You're only allowed to trade in key levels. All right. So this is what this slide represents. So the right key level is like stepping into the right room. Now, once you've stepped into the right room, you need to read that room. So in other words, you need to know who is doing what and what they represent. In other words, what's going on in your key level? What are the aggressive buyers doing? What are the passive buyers doing? What are the aggressive sellers doing? What are the passive sellers doing? So you want to read the message inside of your key levels. And then once you've read the message, you need to understand that message, which is the T.R.A.P method. So think of it through this way. All you're doing in trading is you want to step into the right room, read that right room, and then trap the main message. This is the analogy. So step into so this is the key level, read what's going on in the key level, and then extract the main lesson. And that's what the T.R.A.P framework is about. So there was my entry. So I reached about 825 to make 875, so just about a 1 hour risk reward. I was kind of expecting price to go down here. However, I bailed out early because we were counter trend in a low volume area. Price was, we had lots of buying momentum, so I didn't feel comfortable holding. I was happy to take whatever I could, right? Quick scalp. However, that was a trade. And now you want to focus on a couple of things. You want to focus on the entry and you want to focus on my stop loss, because I get lots of questions about why did I enter there and why did I put my stop loss where I did. All right, so I'm going to look to answer these questions. So if we just start with the entry, for example, right, let's break things down. Now, we don't need to read the numbers for this. I'm going to explain why you don't need to read every number in the next 2-3 minutes. So bear with me. So if we just take a look here, this is the candle that got me interested, this one here. Now we have a big red candle. Okay, but what do we see at the top? Just right there. What is that at the top? Blue delta. All right, what did blue delta represent? More aggressive buyers. Notice the word aggressive. More aggressive buyers than aggressive sellers. Then we actually broke short. This candle and the following candle, lots of momentum as we break short. Okay, so when I see a blue delta and the market breaks below my level, what does that mean? It means that these aggressive buyers over here were not really successful, because if they were successful, they would have broken above the level. We also left a zero over here, right? So if I go back and show you here, this is that same candle over here. We left a zero for 66, and then we broke below the zone with lots of aggressive buyers here, and also here a lot of aggressive buyers. So what does that mean? Okay, what it means is buyers or aggressive buyers were unsuccessful at breaking above the level. What it means is that there are sellers sitting in this level. This is at this moment of time, this is a strong area of supply, because we are absorbing these aggressive orders. Even over here, we're absorbing those aggressive orders, and that's where my entry came from. Okay, that was my entry over here, roughly 75, 29.75, 75, 30 area, just over here. So that's essentially why my entry came. Okay, the other reason it came is because there was a zero at the top. So I want you to think about this, think this through logically. Okay, let's start with this candle. When you see zero for 102, what does that mean? 102 aggressive buyers and then no aggressive sellers, right? 66 aggressive buyers, no aggressive sellers. Even over here, same sort of theory. 0 sellers, 17 aggressive buyers. Market still breaks lower. So it's showing you in this key level, sellers are absorbing the aggressive buyers, which means that sellers are in control. This is an area of resistance or an area of supply. So if you trade support and resistance or supply and demand, This is how resistance forms. This is how supply forms. It forms based on what the market is doing, what the order flow is doing inside of those levels, nothing else. Okay, so that's where the entry came from, aggressive order flow entry at the level. Stop loss, essentially where I like to put my stop loss is just above a 0. Okay, that's where my stop loss was, right? So I trailed my stop loss down. Eventually, I was comfortable to have my stop loss just above the 0 for 66. Again, it's a finished auction, which means that the aggressive buyers and sellers have kind of, in quotes, they finished trading there. They're no longer interested in trading there. That's why we call it a finished auction. So in other words, price is less likely to visit there again. Therefore, I will be comfortable putting my stop loss there, right? That's the basic logic behind that. Okay, so that's where my entry came from. Aggressive buyers failing, we break below the key level from pre-market, and stop loss is where the 0 is. Okay, now the final thing is I'm going to go through my B.O.L.T breakout blueprint, which is essentially the 4-step process that I use to execute on the lower time frames. So let's break it down. So this is sort of a quick recap of what I just went through. So first I'm looking for a body break, right? I'm looking for one candle's body to break below the zone. So I had it here, okay? Notice what's interesting here is we actually had a lot of buying at the top, right? Lots of aggressive buying, and then we break lower. I like these type of candles because these candles here represent that there was some buying activity which have obviously failed, because if the buying activity was successful, we would have broken above the zone. But the fact that we broke below the zone with a ton of buy orders here, buy orders here, buy orders here, it shows you those buy orders were unsuccessful. They were absorbed. They were trapped. Okay, so this is what I call a break or a successful break, because I've confirmed the break with order flow. Okay, awesome. Next is about optimal retest. So I want to see price coming back into the zone. We had lots of buyers. Okay, and this is what the chart actually looked like, right? We had a break. We had a huge amount of buyers coming halfway up to the zone. Then we broke below the zone. So that's what makes me pull my trigger. I want to see a break. I want to see a retest or an optimal retest coming back into the level. I want to see liquidity absorption. What do I mean by liquidity absorption? So I see a lot of traders, they use liquidity, or they try and use liquidity or liquidity sweeps, all these things. Now, you cannot trade liquidity without actually reading the orders, because the orders tell you what's going on with liquidity. So you can't see a quote unquote sweep without actually reading the orders. But when you read the orders, or you at least understand what's going on, again, you can see lots of buying liquidity or lots of buy orders, and being absorbed here, and again break optimal retest. This is the optimal retest. We see lots of buy orders, aggressive buy orders being absorbed. This break over here is confirmed. This is where I entered because I saw the buyers failing. That's what made me pull the trigger after I had a break, retest, and liquidity absorption. That's when I pulled the trigger. Okay, so just wanted to go through a trade recap, breaking that down. Let's just go through one more time what we've been through. So what we essentially went through was this. We went through the 4-step positioning process. We went through, the idea of, how I find key levels, using the 4-step positioning process. Then we understood order flow, right? How to actually, what does the footprint chart represent? What does the blue mean? What does the red mean? What does the left number mean? What does the right number mean? We went through all of that through the reading formula or the reading recipe. Okay. Next was the T.R.A.P framework. So it's about understanding when aggressive buyers do not break above the level, the aggressive buyers are trapped. And that's the reason the market moves down. And you can inverse that logic when the market moves up. All right. And the final thing was the B.O.L.T breakout blueprint. So the 4-step process I use with order flow to confirm my entries. All right. So structure, targeted liquidity, equilibrium, price imbalance. We go from a relatively naked chart to a chart that looks packed full of key levels. And so that, right? So your chart wants to look something like that, where you apply this STEP, the structure, targeted liquidity, equilibrium, and price imbalance. You want to use all 4 steps to identify which key level to trade from. All right. Then we went over the price imbalance steps. So previous day high or low, price imbalance, and then draw the box. It's important that you use the candle before the fair value gap to help you find the best key level. All right. And then we went through the idea of the key level itself. And then this is where we want to bridge the gap between whatever strategy you use and order flow. So once you have a mechanical system to find key levels, the only way you can enter off them is by realistically understanding order flow. So we went through the idea of time, price, and volume and order flow. Okay, so this is the R.E.A.D method, which I want you to understand, right? So you have recognize, evaluate, assess, and detect. And all of that helps you find who's trapped in the market. So in other words, the short trade that I took here, this will be the last slide I go through, my entry and also my stop loss placement really came down to understanding who's trapped. So once again, when you see lots of blue delta, it means that buyers are being aggressive, but they were not able to break above the zone. On 2 occasions, we had buyer aggression. We broke lower. Buyer aggression on the second break, I took advantage of this key level, went about 1R short. Okay, using the basic concept, right? The basic concept I used was this. And so I'm going to leave you on this. This is basically how I trade. So I want to step into the right room. I want to read the right room. And then I want to read the room. Then I want to trap the main message. So in other words, I want to step into the right level. I want to read what's going on in that level. And then I want to trap the main message. And there's only 2 main messages. Either buyers can be trapped, which is what I had today, or sellers can be trapped and I go long. Okay, so just remember this one trading framework, the T.R.A.P trading framework. Step into the right room, so get your key level. Read what's going on in the room, so read the footprint charts inside of your key level, and then understand a buyer's trapped or a seller's trapped.